Well, welcome back, Investorholics and friends, to another ETF Spotlight review. Today we'll be taking a closer look at VBND, which is a Vanguard Global Aggregate Bond Hedged Index ETF, brought to you by the fantastic folks at Vanguard. So this one might be for investors seeking exposure to a diversified portfolio of international fixed interest securities. Obviously, try to be unaffected by currency fluctuations due to the hedging. Is backed by a competitive price, sound index, and Vanguard's indexing capabilities, and all those things form a bit of a positive view on this one. This one probably should be looked at for investors with a medium-term investment horizon. Someone seeking steady and reliable income streams, so it's not going to shoot the lights out if you're looking for capital appreciation. Hang around. This is going to be very educational and hopefully add some value to your investing knowledge. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, investment objective. Vanguard Global Aggregate Bond Index Hedged ETF seeks to track the return of the Bloomberg Barclays Global Aggregate Float Adjusted and Scaled Index hedged to the Australian dollar before all the fees and taxes and expenses and all those great things. So a quick overview of the fund. The ETF provides low cost exposure to high quality income generating securities issued by governments, government-owned entities, government-guaranteed entities, investment-grade corporate issues, and securitized assets from around the globe, the great world of the world. The investments in the fund are predominantly rated BBB- or higher by Standard & Poor's or the equivalent rating agencies. The fund is hedged the Australian dollar, so the value of the fund is relatively unaffected by currency fluctuations. The Y factor, so we're looking at some competitive long-term performance here. So Vanguard Investments approach provides investors with an efficient way to capture long-term market performance. Diversification, the fund invests in a diversified portfolio of securities, which means the fund is less exposed to the performance of fluctuations of individual securities. As always, low cost is a factor in anything we do, because the lower the cost, the better performance that the investor will get over time. So the fund has a low ongoing fee, as Vanguard strives to minimize the costs of managing and operating the funds. As we all know, Vanguard works for you effectively once you become an owner of the ETF. They are kind of like a non-profit type organization in a broader sense, but probably one of the companies with the lowest fees, and low fees mean good performance for the investor. Okie dokie, so we had a net asset value at the close of $52.90, trading just above that at $53.02. Market cap of $190.9 million. Management fee is a very reasonable indeed, 0.2%. So for every $1,000 you invest, it'll cost you $20 to manage that $1,000. Distribution frequency quarterly, January, April, July, October. So money will come to your pocket in those months. Dividend yield is pretty low, 1.95%. So this ETF can be used for investors that are seeking exposure to a diversified portfolio of global fixed interest securities. So after the most recent market crash, the current price possibly represents a good opportunity to build a position for long term. What I try to advocate is long-term investing. Really, I don't think it's a good idea to be trading in and out of ETFs anyway. We want to find a good ETF, we want to buy in, and we want to take advantage of low costs and good management, or good index, I suppose. So for investors on their journey to build a balanced portfolio, this ETF could be used as a cornerstone investment. So you know, so pretty much it's good sector allocation of the bond holdings, and they're focused on treasuries and corporate bonds. So treasury bonds, so you know, government or government institutions, you're looking at 51%, and also corporates looking at 24.3% of the bonds. So as always, we want to be checking and looking around for other alternatives, because we may find something that's better for us. So we want to I want to give you some other alternatives. So have a look at GGOV or VEFI or VIF. There are some other possible alternatives, but like I mentioned in a couple of these other videos, the alternative for the bond world is quite broad, actually. You know, want to be looking at something with a decent dividend yield anyway, because you know, pretty much under 2.5–3%, that's pretty much below inflation, and we always want our value of our money to be increasing, not decreasing, due to inflation. Okay, let's have a look at the top 10 issuers here. So the United States Treasury, Government of Japan, Republic of France, Federal National Mortgage Association. I'm assuming that might be Freddie Mac, actually, America, one of the big mortgage companies in America. Republic of Italy, Federal Republic of Germany, UK and Northern Ireland, Government National Mortgage Association, and we got the Kingdom of Spain, Republic of Korea. So that's your top 10 holdings. So there are limited alternatives to VBND in the listed market, but unlisted space you know, provides more choices, as always. Some of the unlisted active peers hold greater risk, particularly in credit, and are more costly. You know, if you're looking at an active product, it's always going to be more expensive, so that's why we look at the index products. We want to keep our costs down, because that's what's going to benefit the investor over long term. So higher costs means your broker or the management company is making the money and you're not making the money, so we're not investing in things that don't make us money. Overall, BVND is a solid low-cost option, offering investors effective and diversified exposure to global bonds. So Morningstar give this a bronze rating, which is 3 out of 5 stars, so not too bad. But you know, for me, I still want something that's got a better dividend yield. Like I said, we don't want to have an investment that is losing money in real terms, so due to inflation. So you're only looking at a little bit over under 5%. Actually, take a closer look at this graph here since inception. So it's not really returning a great deal. So for me, even though it gets a reasonable rating, I mean, if you're into bonds and that's what you want to do, and that's how you want to build your income side of your portfolio, then I think it's a perfectly decent and relatively safe investment as far as investments go. But always do your research and have a look around, because that's where you're going to get find the best value, I should say. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.